So let's move on to today's NSP webinar, FHA Mortgage Financing, Supporting Neighborhood Stabilization Programs. The webinar is designed for NSP grantees who use FHA Mortgage Insurance. The presenters will cover ways in which FHA programs can be used to support the successful implementation of NSP, including acquisition, rehabilitation, and resale. In addition, the presenters will address issues surrounding FHA use with NSP as it relates to lower down payments, payment of closing costs, bulk and competitive sales programs, and other issues. So we have two people with us today well-versed in the FHA mortgage insurance and how FHA financing fits into an NSP program. Arlene Nunes is Director of the Home Mortgage Insurance Division at HUD, and Matthew Callahan is a broker-owner with Civic Center Home Loans and Renew Real Estate Sales, and Matthew is in Whittier, California. Welcome to you. And rounding out the folks you'll hear today are the NSP managers from HUD headquarters, John Laswick and David Noguera, and hello to all. So we've got today our objective to explore the use of FHA home financing in neighborhood stabilization programs. And Arlene is going to be taking us through Section 1, and so the FHA home financing overview. And then Matt Callahan will be discussing layering NSP subsidies with FHA loans. And both Arlene and Matt will be taking on the third and fourth sections together, special FHA issues and NSP programs, and helping NSP buyers become mortgage ready. So that's what we're going to be doing today. And with that, let me hand things over to Arlene Nunes. Hi, Arlene.
Good afternoon, everyone, and good afternoon to you, Ken. I'll make sure I've got a handle on these slides. Okay, so today we are going to address, what FHA financing is about and how it can be used within the NSP program. We're going to explain to you how FHA-insured mortgages can be a good fit for purchases of NSP properties. We're also want to make sure that everyone is aware that FHA insures mortgage loans that are made by approved lenders. So FHA is not a direct lender. FHA insures mortgages against default for FHA-approved lenders who actually underwrite mortgage loans in accordance with FHA guidelines. Now, many of these FHA-approved lenders are actually originators of these loans as well. Some are not. But FHA originators include federally chartered financial institutions such as banks and credit unions. We also have mortgage banks and brokers that originate FHA mortgages. And finally, we want everyone to understand that FHA mortgage insurance helps to recycle mortgage capital back to local markets. So basically, FHA creates liquidity in the marketplace when other sources of financing have dried up. FHA has been there to fill the financing gap. Now, FHA supports the success of the local NSP by, of course, serving more qualified borrowers. We incorporate NSP and other home buying subsidies. We lower the down payment requirement for many of the purchasers, and we provide rehab funds that can be incorporated in with the initial acquisition financing. And this is done through our FHA 203K rehab products, which I will discuss on the next slide. So basically, FHA has several types of products, but the ones that we believe that are most appropriate for NSP properties are the 203K and the 203B programs. So the 203K mortgage may not exceed the lesser of the sales price and the rehab cost, or 110% of the after-approved value. So we've got two types of 203K mortgages. We have the Streamline product, which limits the rehab amount to $35,000. And then we have our standard rehab 203K. With this particular product, this is where you follow the lesser of the sales price or the rehab cost, or 110% of the after-approved value. When you are using the standard K product, you must use what's called a HUD-approved 203K consultant. A 203K consultant is required for your standard product. And so our inspections are also required to ensure that the work is completed. Now, when you have the 203K standard product, you have the lenders that are monitoring the disbursements from the escrow account. And, of course, there are inspections that verify that work in place has been completed. Okay? Our second product is the 203B product, and that, of course, is our flagship product. Now, the 203B loans may be used to purchase homes with a mortgage that cannot exceed 96.5% of the lesser of the sales price or the appraised value of the home. Now, the property must meet FHA standards prior to loan closing. So these standards are really the property and site standards, some of which relate to health and safety issues. Now, the maximum FHA mortgage is established based on metropolitan areas and non-metropolitan areas. Now, the maximum mortgage term is 30 years. However, I do want you to also realize that we have loans with terms of 20, 10, and 15 years, as well as ARMs. Standard practice, though, is a 30-year term for the FHA product, for the 203B. Now, FHA does not set interest rates or points, and these are normally negotiable between the borrower and the lender. When you have the 203K loan, you also have some extra costs that may be related to the inspection. This, of course, is with the 203K standard product that I mentioned earlier. Eligible properties for the 203B and 203K are 1 to 4 units. Now, this must be your principal residence, but if you do have a 2 to 4 unit property, you can also rent out some of those units. You're not limited to single family, 1 unit property. Condominiums must be located in FHA approved projects. So individual condo units are eligible for FHA financing as long as the condo project has been approved and meets the condo project approval requirements of FHA. The next slide deals with the costs of the mortgage, the FHA costs of the mortgage. Now, FHA loans require an upfront mortgage premium, which is equal to 1.75% of the loan amount, and it's usually financed into the loan. Now, I want to be specific here and let you know that this particular slide relates to purchase loans, and we're talking normally of a 30-year product here. FHA-insured loans are also subject to an annual mortgage insurance premium for purchase loans with terms greater than 15 years and an LTV greater than 78%. The MIP on that particular product is 1.25% of the loan amount. The upfront mortgage premium is paid one time when you first at the closing. The annual mortgage insurance premium is paid on a monthly basis. Now, when the lender considers a borrower for an FHA-insured mortgage, there are 3 key underwriting questions that must be addressed. First, does the borrower have sufficient documented income? They'll then look at if the borrower has enough verified assets for the down payment and assets sufficient to cover all other expenses necessary to close the loan. And thirdly, the borrower must meet the FHA credit requirements and demonstrate both the willingness and the ability to repay the loan. So these are among the key underwriting requirements. However, there are others, of course. So this is three major ones that the lender looks for. Now, many of you already know that FHA does allow multiple liens on the property, but there are some restrictions that apply. The first is that the FHA-insured mortgage, when combined with any second mortgage or other junior lien from a government agency or nonprofit agency considered an instrumentality of government, it cannot result in cash back to the borrower. That's one of our main restrictions. The second is that the FHA-insured first mortgage cannot exceed the FHA statutory limit for the area where the property is located. So the combined indebtedness of the mortgages may, however, exceed the FHA statutory limit. However, NSP limits the maximum CLTV to 100%. Get into some income sources that are considered as part of the underwriting. Now, all income that's used for an FHA loan must be verified, stable, and expected to continue. And this expected to continue is especially relevant when you have Social Security income and disability income that are used as income sources for the borrower. Undocumented or stated income sources cannot be used to qualify for an FHA loan, and borrowers must have documented 2-year employment history with explanation for gaps. So if the lender is using our automated total system to determine whether or not this is a qualified or whether or not the loan has been approved, if they're using the total scorecard, an explanation is required if there are gaps greater than 6 months for employment. If the lender is doing a manual underwrite of the loan, there is no need for an explanation. There is a need for an explanation for any gap in employment. So 30 days or greater, and you're doing a manual underwrite, then you would need to provide any gap, an explanation for any gap in employment. Acceptable sources of income. Now, some of them include, of course, your wages, commissions, business operations, any type of government benefits that you may receive, alimony and child support. Now, we do require that income must be documented through pay stubs, the W-2 forms, the tax returns, or any other means depending on the source of income that you're documenting. Acceptable sources of income, as I mentioned earlier in the previous slide, may include some direct payments from governments that subsidize the borrower. So disability income, any supplemental Social Security income would fit that category of direct payments from the government. Mortgage credit certificates that are offered through your state and your local housing finance agencies are a great way to boost the NSP borrower's home buying power. And of course, any Section 8 voucher payments can also be used. And when you have your mix and your Section 8, they may be used as additions to gross income or to offset your monthly payments. Here's some special considerations that we have with NSP programs. Now, FHA in their underwriting allows income from the non-occupying borrower, the cosigner, to be considered and to be used to qualify. NSP, however, they restrict the type of income that can be used. So NSP participants who will own and occupy the home must meet the household income requirements, but the non-occupying cosigner income will need to be excluded from the eligibility calculation. So this is one of the main differences between NSP and FHA. Another difference is pre-purchase counseling. It is a requirement under NSP, however, under FHA, it is not a requirement. But since when you're using the two programs together, certainly you would need to have your borrower go through the pre-purchase counseling.
Yeah, this is John. Yeah, I think the difference on this is that we actually don't include cosigner income on the calculation of the income for qualifying to meet the program income requirements. So you can't go over 50 or 80 or 120% of area median income. I don't think we would restrict it as far as, having somebody make a contribution on a monthly basis. But we get people more typically, I think, contributing to a down payment or something like that. Right. But we don't consider them to be co-borrowers because they're not occupying the unit.
They're not part of the household.
But they can contribute some money to it, to the transaction. It just doesn't count against the borrower's income because sometimes that would push them over the income limits and then they wouldn't be eligible.
Okay. Now, qualifying ratios. For our manually underwritten loans, your total monthly housing payment or your front-end ratio cannot exceed 31% of your gross monthly income. On the back end, your maximum is 43% of gross monthly income. Now, higher ratios are possible with some documented compensating factors, and some of those may include any reserves or cash savings that you have. We would allow for some higher ratios in that case. When you're using total scorecard, I should say when the lender is using total scorecard, so your front and your back end ratios can be higher for automated underwritten loans receiving an approved or an accept recommendation from total. So, and when I say higher, I'm referring to higher than the 31% on the front end and the 43% on the back end. That is a weighted system. So that weighted system takes into account other factors that on a manual underwrite you may not. So the system may generate an accept even if you have higher front and back end ratios. And you do not need any compensating factors to be cited if you do receive the approve or an accept from total. Now, borrowers must make a minimum down payment equal to at least 3.5% of the lesser of the sales price or the appraised value. That is a statutory requirement for FHA. Now, NSP limits the maximum CLTV to 100%, even if a higher CLTV would otherwise be permitted by FHA. An NSP program could assist a buyer with some closing costs as a grant, but not as a lien against the property that would cause the CLTV to exceed the 100%. So other eligible sources such as gifts, seller credits, they can be used for this purpose to prevent the NSP buyer from being encumbered for more than the current market value of the property. And this is something that Matt will go into some greater detail in his part of the presentation. Now, these are some of the acceptable sources of the down payment, to fulfill the down payment requirement. So these are some, not all, and there's an extensive list there, so I won't go through it, but just be aware that these are some of the sources that are eligible for the down payment. Now, there are unacceptable sources of down payment that we have, and they include contributions either directly or indirectly from a party with an interest in the transaction. And, of course, that has become effective or put into law, I should say, in 2008 under the HERA law. The interested parties are named as sellers, real estate agents, brokers, and lenders. And some of the NSP program sponsors may also be considered an interested party if they take on any of these roles. I want to elaborate a little bit more on this. When we're referring to NSP program sponsors that may fall into this category of prohibited or unacceptable source of income, source of the down payment, really what we're talking about is a nonprofit who is not an instrumentality of government, who offers the down payment assistance to fulfill the 3.5% minimum investment requirement. Anything above and beyond the 3.5% is allowed. However, a nonprofit who is an NSP program sponsor, who is not an instrumentality of government, would not be able to offer the 3.5% down payment minimum.
And actually in NSP, as in CDBG, we are limited to half of the down payment, so they could only really come in for, in your case, 1.75% anyway. So, I mean, that makes a big difference for people, but nobody could pick up the whole thing with NSP or CDBG.
So when you have any instrumentality of government or any government entity are able to provide a 3.5% minimum down payment assistance. I do want to make that clear.
Yeah, not only it's right, this came in with HERA, and it was kind of a sort of moving in different directions, you might say. But so the way that we've worked around this, and it's not very streamlined, I'll admit, but is that if a city were to own the property and want to make down payment assistance available, they can transfer title to a nonprofit, and the nonprofit would then be selling the property, and then the city could do the down payment assistance without breaking the law. So your only option there is to have the property transferred to a nonprofit, and then have the unit of government making the down payment assistance.
Thanks, Jim. Okay. I see that there are a couple of questions that have shown up. We'll wait until the end of the first part. So we'll address those questions at the end of the first part. So please hold tight. Okay. So FHA does not stipulate that a minimum contribution towards the home purchase price needs to come from the borrower's own funds. In other words, if they can get that as a gift, or they can get that from family members, they can get that from instrumentalities of government or any government entity. They could get 3.5%. Now, many NSP programs and some FHA lenders, however, do require a minimum borrower contribution towards the home purchase. Now, that may come as a surprise to you that some FHA lenders require that minimum, but FHA lenders, they do not just underwrite on behalf of FHA. They also are underwriting on behalf of their investors, who many times provide the financing for the loan. So that may be a requirement above and beyond FHA underwriting. So there are NSP program administrators should also clarify if a minimum borrower contribution would be required for their particular program. And again, if you are looking for an FHA loan, you should also ensure that you understand fully if that lender, FHA-approved lender, has any particular overlays above and beyond FHA requirements. Now, a minimum credit score to be eligible for an FHA loan is 500, okay? A minimum credit score for an LTV over 90% is 580. So although those are our minimums, as I mentioned previously, most FHA lenders do require credit score of 620 or more. What they cannot do is accepted credit score below the 500 or the 580, as is stated up there. And the reason why is because we have minimum FHA underwriting guidelines that they must adhere to. So most often what we are finding is that FHA lenders actually require credit scores to be higher than our minimum. FHA also allows or has special provisions for qualifying borrowers with non-traditional or insufficient credit. However, not all lenders will accept borrowers without a credit score, and oftentimes this decision is driven by their investors. So this would be the investors of FHA lenders who buy the loans from the FHA lenders. So in many cases, these investors want to see a credit score, and so the lenders would not be underwriting borrowers who do not have one. Now, in certain situations, FHA may require that debts and obligations of a non-borrowing spouse be considered as the borrower's debt. And the special circumstance in which that would be the case would be in communal property states. So in those particular states, we do consider the non-borrowing spouse's debt. And then the pre-purchase counseling and NSP program should always include a review of the borrower's tri-merged mortgage credit report. Just to recap some of the main differences between FHA and NSP. On the FHA side, we have no limit on the CLTV for 203K loans. On the NSP side, the limits for the CLTV are the cost to acquire the property, and Matt will go over in a particular slide in his presentation what encompasses the cost to acquire the property. FHA does not have a pre-purchase counseling requirement, but NSP does. In terms of the income of non-occupying co-borrowers or co-signers, they are considered in qualifying for FHA and NSP. They are excluded from the eligibility calculation. Those are the main differences between the programs. And with that, I will hand it over to Matt.
Yeah, let's take a couple questions first. And Omega, I see your hand up, but no phone. And let me just remind you that to ask a question verbally, if you don't have a phone icon next to your name, follow these steps. And let's see. So Jeannie would like to clarify that with NSP, a buyer can have a non-occupying co-signer on the loan.
Right. Yes. I mean, NSP doesn't have a prohibition against that. Your lender might, but we don't. All we're saying is that the reason we brought that up is that the question has come up: does a co-signer's income count towards the family income of the family that's buying the house? And the answer is no. They're not occupying the house. They're just a backstop on your loan. So if your lender will take a co-signer, it's still just the family's income that we're looking at, not the co-signer's income. But that's a decision that's going to vary from lender to lender, I would think, program to program.
And let's go to Patricia. Hi, Patricia. Where are you calling from?
Hi. Are you there?
Yep.
Hi.
Where are you calling from?
Port St. Lucie.
Oh, very good. And go ahead with your question.
I'm just asking, in the first part of it, and I'm not sure it wasn't clarified later, but where does it say that NSP limits the combined loan to value to 100%? I heard a reference to that, and
kind of implicit, Patricia, but we have said for a long time that you can't sell the house for more than the lesser of fair market value or total development cost. So anytime you go over 100% of fair market value, assuming you've got higher development costs, then you are encumbering the family with more debt than the property can sustain. If that family had to sell it next week, they would take a loss, and so it comes from that. We're aware that other lenders sometimes go somewhat over that, and that's fine. But in our situation, we have a lot of these houses because people got in over their heads, and we don't want to keep doing that. And so we can go up to 100%, but not over.
So you're basically saying that most of the time the closing costs take you over 100% of the sales price.
So we're saying that.
So you're not allowing the governmental entity to cover the closing costs in those cases?
We are allowing them to cover the closing costs. In fact, that's what we want you to do. We want you to cover them out of somebody else's money than the borrower's money. So in those circumstances, when you have NSP funds, you really have no reason to go over 100% because you can bring it down to 100% with a soft second or a grant or however you structure it.
No, but that's what you are. That's what you are doing. If you're covering the purchase price plus the closing costs, you're going to go over the combined loan to value into like 105%.
Well, but the loan itself is going to be 100%, and the grant's going to be 5%.
Yeah, you wouldn't structure the closing costs in the form of a loan.
So you're saying that you have to give a grant for the closing costs? Is that
right? Yeah, or a loan, or forgivable loan, or anything else. It's just, a forgivable loan, yeah, or a non-recourse loan.
Well, that's what the loans are in most cases. The second secondary lending is usually a forgivable loan or a deferred loan or something. So if you do that, then you're going to go to like 105 or higher.
I misspoke. I meant non-recourse loan. So you cannot have recourse beyond 100% of the value. Otherwise, the family is underwater the day they sign the note. We don't want that.
Okay, I'm not sure what you're saying on non-recourse.
What I'm saying is that if your costs go over 100% of the value of the property, then that has to be covered with a grant or a non-recourse loan, not a forgivable loan, but a loan that just a note that just acknowledges that funds were paid, but that they are not required to be repaid. Okay, now I realize most forgivable loans are never repaid, but they are still loans. You can make a non-recourse loan. It's basically just a piece of paper that says we have this much money in the property, but we can't come back to the family and ask for that to be repaid under any circumstance. That's different than a forgivable loan. Forgivable loans are repayable under various terms. It may be 100% repayable for the first 5 years and then 10% less, for the next 10 years. But there's still payment that's going on. A non-recourse loan is just a way of recording your investment in this property without encumbering the borrower.
Okay. Well, I'll have to find out how to do that. I've never heard of that before. Okay, thank you.
I'm not suggesting that you need it. I'm just saying that if you...
Well, we do need it because our borrowers don't have that kind of money to put into closing costs and down payment and so on. So
and you make a grant to them. That's what the NSP is for.
Okay, thank you.
Thanks, Patricia. Appreciate that question. Let's go to S. Dean. Hi, S. Are you there?
Yes.
Hi. What's your question?
I actually got an answer back. I wasn't sure what the acronym CLTV meant, and I got a response back that it was combined loan to value.
Very good. Glad to answer that question for you. Thank you. And let's go to Bob. Hi, Bob.
Hi. I've got two questions. One is, has FHA approved loans on land trust properties? I understand that's been in the works for some time. And then the other question was for HUD. Does HUD require us to pull a tri-merged credit report? Or in most cases, we usually use a one credit report.
Yeah, we do require, FHA requires a tri-merge.
FHA does, but I didn't know if, my question was on...
NSP program doesn't have
FHA, does HUD require us to, if we're doing direct lending to the borrower, they require the tri-merge?
Those are local policy calls, Bob. We don't require that specifically. I mean, we require that you underwrite, but we don't say what it has to be, in detail like that.
Okay, I just misinterpreted one of the slides. Thank you.
Okay. What about the land trust?
Okay. I have a question for you, Bob, on the land trust property. Are those ones that you're talking about with deed restrictions?
Yes, ma'am.
Okay.
This is going to be like they buy the improvements and they lease the land for under a 99-year ground lease.
We do have some properties with community land trusts that have been insured with FHA financing out in Colorado. But I do want to be very clear that anything that has deed restrictions, those deed restrictions cannot survive foreclosure.
All right.
And the program...
Does FHA provide... Fannie Mae has a rider that they put on the ground lease that basically covers that. Does FHA have a prescribed rider for the ground lease along those lines?
No, we don't.
Okay.
We are aware of the Fannie Mae rider. We are looking into that. But at this time, we do not allow the deed restrictions to survive foreclosure, and nor do we have a rider in place at this time.
Yeah, I just ran into some questions on that last week too. So what happens then? Does the trust lose the land?
No, the land is. I mean, what we're insuring is the property, right?
Okay. So you take title of the property. They maintain.
Well, we're insuring we insure the loan for the improvements on the property.
Right. Which doesn't include the land.
Correct.
So the trust won't lose the land then if you foreclose on the real estate, on the building.
Right. The land is still there. And that would be the same thing on
Indian reservation. Have a say in who you disclose.
Where it gets sticky is that the deed restrictions that we want to prevail are the income guidelines for the affordability period and stuff like that they don't want to prevail.
Yeah, and that, at this time, the deed restrictions do not survive foreclosure. We are looking into waiving some requirements. There was a roundtable that took place on May 8th where we had a very lengthy discussion on deed restrictions, and a lot of the CLTs or the community land trusts were actually participants of that roundtable. And what you just voiced here, your concern over the lease and the leasehold and the improvements were actually discussed during that roundtable. And we were very clear that at this time the deed restrictions will not survive foreclosure. But you won't lose the land either.
Yeah, I should say that, Arlene and her team have really been taking a hard look at some of these, sort of glitchy places between our programs and really trying to figure that out. So they're not all solved yet, and some of them are embedded in legislation, which we can't really change. But they are asking questions and learning about what's giving people problems so they can try to fix it. So we'll keep making improvements as we go forward.
Let's go to Mike, who's got his hand up. Hi, Mike.
Hi. Got a couple of questions for you. I heard a comment, something about half of the 3.5% because of CDBG.
Right. So in the Housing and Community Development Act, we have a category of eligible activity called homeownership assistance. It's a pretty big category because it includes mortgage insurance premiums, first-year mortgage insurance premiums. It includes, the big one is principal and interest reductions. So in effect, you're allowed to use CDBG and also NSP money to write down the principal amount virtually without limit, as long as there's legitimate financial reason for doing so. But the law says that you can only pay half of, you can pay up to half of a down payment. So we interpret that as the cash equity that a borrower has to bring to the table. And in FHA's case, it's 3.5%. So you would be limited using NSP or CDBG funds to paying half of that amount, and then the borrower would have to come up with the other half. That's just part of the law. It's confusing because it was in the regulations and then it was out of the regulations and then the law changed back again and then never came back into the regulations. But we have some policy alerts on that, so that's been around for a while. But people think, oh, that applies to that 50% applies to the principal reduction, and it doesn't. It's just to that down payment, just the equity payment.
But gift funds could be used to fill
Sure. Yeah. Right. It's just our funds are limited to that. So exactly. So yeah, you have your parents give you some money or something like that, then that's fine.
So if you had another governmental agency program, they could pick up the other 1 3/4 for the borrower.
You're good.
Yeah, you could be. I mean, I think the reason that some borrowers have these cash requirements is that, it has been proven that people, stick with a loan longer if they've got some of their own money in it. So sometimes it's more symbolic than anything, but no, as far as we're concerned, the only limit is that you can only pay half of the down payment with NSP or CDBG funds. Where you get the other half is not limited.
And then my other question was going back to clarify on that 100% CLTV. So if I heard correctly, you're indicating that an NSP recipient could provide a gift for the closing costs, but they couldn't secure it with a forgivable loan.
Exactly
through
right.
the end. Okay.
That's exactly right. And again, closing costs are part of home ownership assistance, but they're not part of the down payment or the equity requirement. So you could make a grant of that.
Let me ask one last question. Is the CLTV just that of the FHA first mortgage and the NSP lien, or
combined? So that's everything.
That would eliminate another DAP program from a governmental agency from providing that closing cost assistance as well when NSP is involved.
We would rather have you pay that as a grant.
Okay.
We would rather have you not be over 100% of value, but we also know that all development costs and values are backwards these days, so we're getting into that, but we just don't want to get people into a negative equity situation.
But the other thing I just want to mention, though, is the development subsidy, right? So to the extent that beyond whatever the value is, which is the basis that FHA is going to approve a mortgage, beyond that, if there is an additional expense that you have to incur in order to make the home affordable, then NSP funds would pay for that, but you'd consider that to be a development subsidy, and it wouldn't factor into the lien that's being placed on the property.
Thank you for those questions, Mike. And let's go back to just a couple more questions now, and then we'll move on to Matt Callahan. But let's go back to Jeannie, who has a clarifying question about the co-borrower non-occupant. Hi, Jeannie.
Hi, how are you?
Good.
My understanding was that with NSP, you could not have a non-occupying cosigner, and that was because then you have a second technical owner of the property that does not occupy it as their primary residence, and that kind of violates down to the core of it.
Well, I think we got our we took our guidance from the Part 5 rules on income calculation that the Home People published a number of years
right,
ago.
which I have no problem with what you said, that, you know, they're a co-signer that's not occupying, of course, they're not a member of the household. Their income wouldn't count towards eligibility. But say I'm an eligible home buyer and my mother wants to co-sign on my loan. Unless she's living with me, the way I understood the program, she can't co-sign my loan because she wouldn't be occupying the property.
Did you say that?
So I get from your side what you're saying about, you know, that of course you wouldn't have a non-occupying co-signer count towards your income eligibility, but from the other side of it, I was unaware that you were allowed to have a non-occupying co-signer because then you have an owner who it's not their primary residence.
Well, I don't think we consider co-signers owners. I mean, maybe technically they are, but I mean, I'm not aware. David and I are not aware of that restriction in NSP. In fact, why would we allow you to discount their income if we didn't allow you to co-sign? I mean,
and at least in my area, if you are a co-signer on a mortgage for a property, your name is on the deed.
That's right. But the focus of
But then if your name is on the deed, you are an owner of the property that those deed restrictions go along with.
Okay, but you're focusing on who the owner is and not who the beneficiary is of the fund, right?
Correct.
And what the CDBG regulations speak to is who benefits from the NSP investment, right? So who is the household? It doesn't speak to whose name is on it.
Yeah, it's really about the occupants, right? So I mean, if this person wants to take on the liability of co-ownership without the benefit of occupancy, that's their choice, but we're not prohibiting that.
Okay, great. Then I wanted to kind of piggyback off something that a lady had touched on before, and that was the not exceeding 100% CLTV, and then we came back to it with developer subsidies. So our particular homes it cost about $150,000 to build a reasonable market home in our area, but the market can only support about $90,000. So with our deed restrictions, we have to include the full amount of NSP. So we're 170% CLTV, and we've been doing portfolio loans so far and haven't ventured into FHA, but I have a buyer that's interested. So I would not be able to have a recapture provision or second lien for the amount of NSP funds that I'm liable to HUD for.
No. So that's the development subsidy David was referring to. So anytime your development cost exceeds the value, you write that off, and that's a sunk cost, and that money just, hopefully plugs the hole in your mortgage market.
Right, but you as HUD could still come back after me for that full amount. You guys don't write off that developer subsidy.
Yes, we do.
You do?
What it comes down to is the resale or the recapture provision that you place on the property. The only rule that we would use to clamp down on that $60,000 would be if you used a resale approach, where in resale you're looking at the total NSP investment being made in the deal.
Right.
But if you're using a recapture approach, then that amount would be based on the subsidy that's going directly to the home buyer. So forget about the $60,000. Focus on the $90,000. If you're going to provide,
let's say you make a down payment or in closing cost grant of $5,000 to the family, then you're in a recapture scenario
for $5,000,
right?
Not $65,000.
Right. And that's totally legitimate.
Right.
So that's how you get around that problem, because it doesn't make sense.
Okay, then with closing costs and the increase over the CLTV, if you at time of you're selling a house for $70,000, but they write their purchase agreement for $73,000 with seller paid closing costs of $3,000, do you still run into that over 100% CLTV that's not okay and it needs to be actually given in a grant?
Well, as long as the seller is providing the amount over the loan, the 100% of value, then no.
What is the value in that example? Is the value 70?
Figure $3,000
Yes.
over.
But you're making a grant. The seller's making a grant.
The seller is providing.
So, I mean, in our case, we would say make the grant from NSP funds, or.
And so don't include it in your purchase.
Share the property on just the 70.
Separate grant.
Right. That's what we're trying to say is, don't get down to the finish line and then trip them,
Okay.
crossing the finish line. So, that make sense?
Thank you very much.
Thank you, Jenny. One more question, and then we'll go back to our presentation. And this question is from Evelyn, who asks, can a principal write-down equal to the rehab amount be used in combination with a 203B or 203K loan?
Well, the principal write-down?
Well,
Whatever
I think you can do it with 203B for sure. I think 203K
Is the rehab.
Yeah, builds the rehab amount into the loan. So I think that's.
Yeah.
Did you say you think that's okay?
No.
No, I don't think you can't do it in 203K. No. You do it in 203B because you're just looking at, again, your only limit would be 100%. So whatever that number is, I mean, it's better to get it down to 95%, or 97 or something like that, through various means. But 203K. Well, we're going to talk more about 203K, right? So let's hold off our anxiety for another few slides, and then.
Actually, what I would like to ask about that scenario with the principal write-down, are you saying that there would still be additional rehab to be done using the 203K, or is the total write-down amount that you're equal to the rehab dollars? Is that the total rehab investment in that property?
And we don't know. That was only written in, and I cannot unmute Evelyn.
You can write back and clarify that. So.
Okay.
Yep. So at this moment, let's go now to Matthew Callahan, and he will take us through the next few parts, starting with layering NSP subsidies. Oops, and sorry about that. There you go. Hi, Matt.
Hello, everybody. This is Matt Callahan, and we're on slide 25, which is an effort to sort of recap everything that we've discussed so far visually. And this is a way of showing how the layered financing would work with an FHA first mortgage and subordinate financing from an NSP program. So I think we've really gone over this, but let me just recap and maybe fill in some gaps. The first layer, and I should back up and say the goal of doing this, the reason why we use layered financing is we want to maximize the home buying potential and power of the NSP participant. We want to give them the maximum home buying power, but at the same time keep their down payment and their monthly payment as affordable as possible. So the first layer at the top is the buyer's contribution. This is the money that they're going to bring to the table. And as we've heard so far today, FHA does not stipulate a minimum borrower personal contribution to the purchase. There's no minimum amount that has to be sourced from the borrower's own funds. And that would be true of NSP guidelines as well. But as it was explained, NSP financing or assistance can only cover half of the buyer's contribution. So in this example, in an FHA loan, the NSP assistance could cover 1.75% of that 3.5% down payment requirement or equity requirement. And the balance could come from a variety of sources, the balance of the 1.75%. It could come from, obviously, the borrower's own funds. And many NSP programs that we've worked with do establish some minimum amount that the buyer is required to contribute. It could be a flat dollar amount. It could be a percentage of the total purchase price. But the balance of that 1.75% could come from other sources. It could come from properly documented gift funds. It could come from a sale of borrower's assets. It could also come from other secondary financing sources, other approved secondary financing sources. So if you have local housing trust funds or state housing assistance programs, those funds could also be used to make up that balance of the 3.5% down payment requirement. The next layer is the FHA First Mortgage. This is a loan that the home buyer is going to be making monthly payments on for 30 years. One of the comments that was made in a preview, that Arlene highlighted, and I just want to accentuate here, is that the power of the mortgage credit certificate program is pretty significant, particularly in an FHA loan, because the dollar value or benefit of the MCC can actually be deducted from PITI. So FHA permits this, and that's a flexibility that's not available in conventional underwriting. So it's a great way of boosting home buying power. So certainly it's a good idea to check with your local and state housing finance agencies to try to incorporate MCC programs wherever they're available. The next layer is the NSP second mortgage. This is a loan that they're not going to make monthly payment. This is the deferred loan. Typically the term of that loan is the same as the term of the first mortgage, but there's no monthly payment requirement during that term. One thing I should add here is that there's also the possibility of additional layers of subordinate financing beyond the NSP second mortgage. To my knowledge, there's no requirement that the NSP loan actually be recorded in second position. So you could have other state or local secondary financing sources that are acceptable under FHA guidelines that could further increase affordability and perhaps allow your NSP subsidy to go further. The final layer is the layer of closing costs. Typically, we expect closing or settlement costs to be around 3 to 4% of the purchase price of the home, depending on local markets and whatnot. And so what we're learning today and understanding today is that NSP funds can be used to cover closing costs only if they're provided as effectively as a grant, so that there's no additional lien recorded against the property that would cause the total combined loan to value or total CLTV to exceed 100%. But other sources of funds could be used to cover closing costs, certainly the borrower's own funds. Seller concessions or seller credits or builder concessions are permitted up to 3% of the purchase price is the typical guideline. Lender credits, sometimes called yield spread credits, could work. And other gifts or grants from other sources could also be considered. So that's the total structure of the financing. I'm wondering, Kent, if it would be a good idea to stop here a second and take any additional questions, because it connects back so much to what we were just talking about.
Let's see what we've got here. You did address Omega's question. Can you recap the down payment? Down payment directly and indirectly from a nonprofit developer that is selling the home. Can the nonprofit provide the 3.5%?
This is one of the things that we've been talking about for a little while now. If you, the grantee, have paid for the acquisition and the rehab, whether it be to a developer, to a nonprofit subrecipient, or if you've done it yourself in-house, you wouldn't take additional NSP funds to offer down payment assistance or to offer a second mortgage, because that would be over-subsidizing the property. What you would do is you would take back less at closing, right? You would receive less at closing to cover that whatever down payment amount you would have given. The only additional funds that you would need in that deal is if you were paying for closing costs or PMI or something to that effect. But you wouldn't need that extra 3.5%.
Is this Sarah's question?
Yeah.
Oh, Sarah's. Okay. So as far as Omega's question, you still cannot use NSP funds or CDBG funds to pay more than half of the cash equity required at closing. So moving it from a nonprofit to a city or back and forth doesn't change the restriction on 50% of our funds being used for that. In fact, the only reason that you would do it is that the only way you can do that, the only way that a seller can provide down payment assistance to a buyer in this program that's limited by the HERA law is to transfer ownership to a nonprofit, and the city would, or the instrumentality of government would make the payment, but it would still be 50% of the down payment, not more.
And Ellen asks, so 1/2 of the down payment can be included in the principal buy down with NSP funds, and the other half is paid by the borrower.
Right.
Or other sources.
It's home ownership assistance. I mean, so it wouldn't be the principal buy down exactly, but yeah, I mean, it all works out to the same thing.
And scanning here. Okay, I think we can move on for now, Matt.
Okay. So the next section, Part 3, has to do with the nature of the secondary financing that you structure using NSP assistance. And I think most of the agencies, NSP providers that are on the presentation today have probably, their programs have matured beyond this point. They've already designed their secondary financing programs. But just as a recap of what's required, first of all, the provider of the NSP assistance, the secondary financing, must be a governmental entity or a approved nonprofit organization operating as an instrumentality of the local government agency. Another key point is that FHA HUD does not approve secondary financing programs itself. It's up to the FHA lender who's going to approve that program. So it's critical to work closely with your lenders to incorporate, to make sure your programs are going to be approved. I saw that one of the questions had to deal with a problem in getting lenders to agree to secondary financing programs, and it's so critical to have multiple lenders involved in your program because many lenders do understand secondary financing programs and are very able to approve them. So a couple of key features of your secondary financing programs is that, first of all, repayment must be deferred for at least 5 years. This is a feature that's going to allow you to not have to count the loan in your debt-to-income calculations for qualifying. Deed restrictions and covenants, as we discussed already, may not be designed so as to survive foreclosure by a senior lien holder. Accrued interest charges should avoid causing long-term negative amortization of the loan. The key here is you want to incentivize homeownership, not make people feel they're effectively losing equity over time. And then any shared appreciation or shared equity plans have to be designed so that they're effectively proportional to the amount of the NSP investment. FHA specifically stipulates that the shared appreciation can't exceed 50%. So one of the issues then that Arlene discussed earlier and was discussed during the question period has to do with, the notion of the maximum CLTV not exceeding 100%, and then the FHA parlance that deals with the so-called cost to acquire, which is the acquisition price of the property plus closing costs, discount points, any repair costs needed to bring the property to, so that it can be sold. And here, of course, we're talking about the FHA 203B loan program. What we're saying with the NSP program is that the maximum CLTV cannot exceed 100%. So to the extent that you need to cover those costs, they need to be covered with non-loan sources that are not going to create a lien against the property. One of the issues that we heard when we were working on the NSP roundtables around the country was that many NSP program sponsors were frustrated because their programs would stipulate a maximum subsidy that they would provide, and lo and behold, when clients were presented, applications came in from lenders, in 100% of the cases, the maximum NSP assistance is requested for the borrower. When in some cases, when looking at the file, it would seem that the borrower didn't need the full amount of NSP assistance. And so really the only way to guard against that problem is to establish in your program a minimum housing expense ratio, for example, 30%. So that the borrower's housing expense ratio is below whatever established minimum you have, the NSP subsidy would be reduced, and the borrower would need to either take on a larger FHA first mortgage or increase their own personal contribution. So that way you can stretch your NSP subsidy without having some sort of stated minimum housing expense ratio. It's going to be hard to fight against or argue against providing the maximum subsidy.
That's a good point, Matt. I think a lot of people think that underwriting really only applies to multifamily deals, but we're expecting all the grantees and their subrecipients and developers to look at these properties and to look at the family circumstances, and you know, we have a wide range of folks we can serve in this program, up to 120% of median. They're not all going to have the same needs for assistance on this, and so you need to be looking at what the family actually needs. You can provide as much as they do need, but you shouldn't be providing more than that. So this discounting is a good way to offset that.
And in my experience working as a lender in these programs, when you don't have these kinds of minimum housing expense ratio, it's very hard to, because the consumer, the home buyer, desires to have the maximum subsidy. It's human nature, and so it makes it easier for everybody if you have an established stated minimum. 203K loans were discussed earlier in real good detail by Arlene, and one of the things that I've been involved with, actually many discussions in many locations and many times about how to effectively use 203K loans and layering in the NSP subsidy. And, you know, there may be some good examples of that working well among our participants now, or maybe you know of some. But it to my knowledge, and I've checked with, for example, with the National Stabilization Trust, there's not a lot of good examples of this working effectively. One initiative that I'm aware of locally here in Southern California that I would bring to your attention is an effort where the NSP program is acquiring very distressed properties, properties that require rehabilitation that would exceed what 203K could address. Acquiring those properties, completing the most critical rehabilitation, and typically the lead-based paint abatement, and bringing it to the level where someone, a home buyer, could come in and use the 203K loan to complete not only the purchase but the balance of the renovation and improvements. And this, to me, seems like a pretty elegant way of doing it. The next slide has to do with FHA appraisal requirements, and I'm going to pass the mic back to Arlene to address this issue. Is Arlene still available?
Yeah. I'm right here. Okay. So FHA does have appraisal requirements, and FHA appraisals are valid for 120 days. There is a possibility, in case you need a few extra days to close the loan, you do have the ability to extend that FHA appraisal for another 30 days, and actually even longer if you still needed you need a few more days for closing. So, except for the 203K loans, the lender should not be ordering appraisals until the NSP program administrator has confirmed that the repairs and improvements have been completed. So, FHA does allow some flexibility there on the appraisal side to close the loan if you need that extra time.
NSP has stuck with a 60-day lifespan on evaluation just because values have changed. In fact, I think FHA originally had 180 at the beginning.
Yeah.
But we did recently add some. Flexibility to get an update on an appraisal for another 60 days if needed. But we feel that going beyond that was just a little too chancy in our markets. So, can you pass the magic ball to Arlene?
Okay. So the one thing that I do want to stress that even though you have that flexibility, if you need on the appraisal side to extend the validity period of that, the lender, obviously, the lender's underwriter bears the responsibility for determining if the eligibility of the property for FHA insurance and the quality of that appraisal report. So really, all responsibility lies with the lender. And the lender's underwriter is allowed to communicate with the appraiser to request any additional clarifications that they need after they review the appraisal. So really, here the point is to stress that the lender's underwriter has full control over the contents of the acceptance of that appraisal and the need for additional clarification on that appraisal. So the next issue will be covered by Matt. So Kent, if you will please transfer the baton to Matt.
Okay, so one of the sort of hot topics that I know a lot of NSP program administrators are thinking about is how can a lease purchase program be incorporated into an NSP program? In many revitalization areas, finding ways to attract home buyers who may, for a variety of reasons, need an initial lease period before they actually take over full responsibility of the mortgage. It could be a very good idea. So there's quite a few discussions going on about lease purchase and how it can be used in NSP and similar programs. And the good news is that FHA does allow for the initial borrower in a lease purchase program to be a nonprofit entity that has been approved by HUD. So there is an underwriting process, if you will, of the borrower, which would be the nonprofit entity that would acquire the property initially and then enter into a lease purchase contract or arrangement with a qualified purchaser, occupy the property, rent the property for a period of time, and then exercise their purchase option by assuming the FHA loan in the future. And so this is something that's permitted. It certainly is something that could be discussed with your lenders and with HUD and to come up with a local lease purchase program using NSP assistance and an FHA. So we bring it to your attention now because we know there's a discussion about this. Obviously, a lot more work needs to be done on it. FHA lender overlays. One of the things to appreciate is that each lender, and Arlene has said this a couple of times, each lender, FHA lender, is going to have their own overlays, and they're fully empowered to do that. There's no requirement that they adhere to whatever the minimum requirements that FHA stipulates. They can typically and do impose different or more strict requirements for FHA loans. And so that's why it's to your advantage in designing and implementing your program to have as many FHA lenders as possible participate, because each will have their own different approach to it, and a buyer who may not be approved by one FHA lender could be approved by another lender. The flip side of that, and here I'm sort of wearing my lender hat, working with NSP programs. One of the frustrations and one of the, frankly, disincentives for participating in a local program is where the NSP program itself has created an overlay or an underwriting requirement that is not required by FHA, that is more strict, say, with respect to credit scores or debt-to-income ratios or income documentation requirements than what we can get approved through normal FHA underwriting. So what that does is make it just much more complicated for the lender to participate in your program. So my recommendation, we carefully consider whether or not it makes sense to impose your own local overlays on what's required for someone to be approved for an FHA loan using your own assistance. Another issue that came up in the NSP roundtables was, frankly, some frustration that NSP program administrators expressed in the fact that they were involved in quite a bit of marketing of their program, their NSP program, and through a variety of ways, websites and workshops and different marketing strategies, and generating a lot of consumer interest in their program. And the normal process is to refer that interest, those leads, if you will, back to your participating lenders and real estate agents. And my advice and recommendation is not to assume that automatically those leads are going to be evaluated for your NSP program only, that more likely your lender and real estate partners are going to be perhaps looking for what they perceive to be the path of least resistance or quickest close, and that they may not perceive your NSP program as being that. So it's critical to track your referrals and leads back to your lenders and reward those lead recipients who are actually converting the referrals into NSP borrowers with more leads. One of the things that we've seen with many of the local jurisdictions we work with is they'll have a comprehensive list of all of their approved lenders and loan officers, and then a subset of that list that describes their most active lenders and loan officers. So consumers are automatically directed towards the lenders and loan officers who are more likely to provide the NSP assistance. This next section, Part 4, really has to do with, again, my perception of working with first-time buyers, other buyers using NSP assistance or NSP-like programs, and what are the issues or problems or barriers that they are facing in becoming mortgage ready. And my encouragement to you is to work closely with those people that are having the first contact with your NSP clients. That may be your nonprofit housing counseling agencies, the workshop providers, and make sure that they're focusing on these issues. I think a lot of workshop homebuyer education providers do a really good job on a lot of areas of mortgage readiness, but not some of the practical nuts and bolts items. So these are the things that I'm seeing on a day-to-day basis that are perhaps causing people not to be approved for FHA financing. The first is you almost can't emphasize enough the importance of documenting income and assets, particularly assets. Consumers really don't get why cash is not an asset, why if they have a large deposit or even a modest deposit into their bank account that can't be sourced or traced, why that would be a problem for them in getting FHA approval or loan approval. Another area is the importance of their federal income tax return. What I tell clients now is they should assume or consider their federal income tax return as sort of like their personal financial statement, and that whatever they tell the IRS in their tax return, we have to believe is true when it comes time for their home loan application. So it's important to have them understand that as they're filing their tax returns, that if they, for example, claim large amount of unreimbursed employee expenses, if they claim the mortgage interest deduction on behalf of somebody else, or other sort of creative things that might help lower their tax liability, it's also going to lower their chances of loan approval. Another critical thing is understanding that the loan approval process is dynamic and ongoing, people always often ask me, how will I know when my loan is approved? And I'll, somewhat facetiously say after you've been living in the house for a month. And it's really true that up to and including the day we close, the borrower's income, assets, and credit will be completely updated and reevaluated. So, buying that big screen TV or changing your job status or, changing your assets in your bank account, prior to closing could really jeopardize your loan approval. So it's important that home buyers understand that. A lot of clients come thinking, that have quite a bit of student loan debt, and they think, well, I've heard it's all deferred. If it's deferred, it doesn't have to be counted, and that's true to some extent, but all deferred student loans have to be well documented, and a big challenge that consumers have is getting good documentation on the status of their student loans, the deferral period, and so as they're preparing for buying a home, that's the time to start getting all that documentation together, not when they're right in the middle of a purchase. Increasingly, in the past, FHA has had flexibility regarding collection accounts and charged-off accounts, and there was some ability to waive the payment of those. But in my experience, most FHA lenders now are requiring that collection accounts and charge-off accounts be settled. So it's once again good to discuss that with their loan officer as early as possible in the process to discuss how those debts are going to be resolved if they need to be. Another issue it's really timely, and it's really something that's come up as a big issue in the last year, is the issue of disputed derogatory credit. It used to be sort of I would say, cavalier advice that people would get from credit counselors that if they had derogatory credit, that they could just dispute it, and eventually it would go away. And in fact, that doesn't work, and what happens is the disputed status sticks with the credit file, and now most underwriters are requiring that the disputed status be resolved prior to the close of escrow. And frankly, I would prefer root canal over trying to remove a disputed status on a credit file. It is really, really tough. So buyers, I think, should be counseled not to dispute derogatory credit. There's other ways to resolve that, or at least not frivolous disputes. It's very common to encounter home buyers these days, very normal, people that had long-term good employment histories, who have had periods of unemployment and over the last 2 years, and it's going to be critical that they document those periods of unemployment, the reason and get documentation from their previous employer and the cause and reason for their unemployment. And that often could be a way to overcome those periods of unemployment. Another issue is gift funds, and this is where it becomes even more complicated because the home buyer is going to be relying on gifts from a closely related family member to complete the purchase. And FHA is perfectly fine with gift funds, but they have to be documented in very specific ways. And so the important advice I give clients is initially what you need to do is talk with your family members about what level of assistance they can provide and their willingness to sign a letter and provide evidence of the funds that will be gifted. The actual movement of money is something that is not that urgent, and just emphasizing with the borrowers the importance of documenting every step of the gift process. And then finally, once again, that all deposits and assets that are being used through the purchase or that are identified in the borrower's bank statements are going to have to be sourced, and any unsourced deposits can very likely jeopardize their loan approval. So, and the very final bullet point is one I made before, that loan approval is a dynamic and continuing process until the loan closes. So I would definitely encourage you to, review these points with your pre-purchase counseling staff and homebuyer education providers to make sure that they are being addressed. I think we're at the end.
Very good. Thank you, Matt. And let's go to questions. There's a bunch of them stacked up. And let's start with a question from Leslie and echoed by Laura. Could you please cite your reference with regards to the maximum combined loan to value for NSP being 100%? Is there a date of written guidance that you can provide? So while you were thinking about that, I'll go on to Tatiana, and let me unmute you, Tatiana.
Hello, Ken.
Hi.
How are you?
Good. Where are you calling from?
City of Miami Gardens.
Very good. Go ahead.
Okay. This is a silly question. We tried to close only one FHA loan, and I think that one of the issues that we had was that we had to deliver the appliances prior to closing. We tried to do that, and the appliances got stolen. So therefore, we decided not to try FHA anymore. Is there any way to work around that? Because I know that most banks actually either don't want to do FHA, or they don't have a secondary market for them, or they don't want any deed restrictions, or they have the issue with the appliances. So we haven't been very successful with any kind of FHA loans.
So I could speak to the issue of the appliances. And this is a local, each lender is going to handle this a little bit separately, but one of the solutions that we've worked out with is if you can get a copy of the paid invoice for the appliances and show that to the appraiser, they very often will issue what's called the 1004D, which is confirmation that the appliances will be part of the transaction at closing. So I think there are ways to avoid the actual installation of the appliance prior to closing. Because, yeah, you're right, in a lot of communities, if the house is not occupied, it creates too much of a temptation to have them stolen.
Okay, do you think that they will accept copy of a piggyback contract with the county? Because we do not pay for the invoices, and the credit card is not charged until they're actually delivered.
Well,
so we don't have any pay invoice.
If there's you're going to need some way to confirm that the appliance will be provided or has been paid for, and typically the appraiser can use that as confirmation that that underwriting condition has been satisfied. So it's hard to go into the details of what exact document would work, but I think it's a question of talking with the underwriter and the appraiser as to what they would accept as confirmation.
Okay.
On the FHA side, one of the property standard requirements is that there is a stove in the property. So we need to make sure that is available at the property for FHA. Property minimum property requirements, yes.
And that includes the appliances.
The stove in particular for FHA.
Yeah, we always deliver a stove and refrigerator for both, and a water heater. Those are the only three appliances that we provide, and they're there in the write-up. But we just don't pay for them until they're actually delivered. So that was the only thing. The only support that I have is a contract. Well, a piggyback contract with the county.
What you're saying is that you provide it after the loan is closed?
Yes.
And is there some other type of final walkthrough for verification or anything like that occurs?
No.
Okay.
No, there is nothing else. I mean, the inspector can go back after we close and verify that, but there is no walkthrough.
Does that happen? Does the inspector go back to verify that that's in there?
I believe it only happened once, and that was the time that we did it with FHA. Other than that, no. regular loans normally never go back to check that.
Yeah, with FHA, you wouldn't need to have that. So I'm glad to hear that when you had an FHA loan that somebody went back to verify that.
Yes, they actually did.
Okay, we should continue that practice.
Okay.
With FHA.
Okay.
Thank you, Tatiana. Good to hear your voice. And let's go now to Dean. Hi, Dean.
Hello?
Yep.
Hello?
Yep. We can hear you. Go ahead.
Oh, yeah. I wanted to go back to the issue of co-signer on a NSP loan. So we ran across a situation where a parent assisted a home buyer in NSP. The home buyer signed the NSP loan, but the parents didn't. But the parents signed on the mortgage with the bank and are included on the deed for the property. And the thought was that it causes some problems with respect to, at least legally, what happens if the actual purchaser, the person that moves into the property, decides to leave for whatever reason, and the parents are then owners of the property.
So you're saying that the parents signed, the parents are listed on the deed, but not on the note.
They're not they're not listed on anything with NSP. They're listed on the deed and the mortgage with the bank.
Okay. Well, so they're co-signers. I mean, so you're saying that?
Are they living in the house?
Do they live there?
No. And their incomes weren't taken into account in terms of
right.
eligibility.
We wouldn't have to be, but so you're saying that they could take over the house after the children leave for some reason and get a good deal or something? Yeah,
so, I mean, it seems like that might happen.
Well, I mean, that's where I think your recapture and your covenants or deed restrictions or liens or whatever you have to cover your long-term affordability and the repayment provisions on any of your soft second financing or whatever you have there should provide for some sort of penalty if if a non-occupant moves into the house. I mean, I'm sure this one didn't, so I don't know how you fix that exactly. But it might be something you want to look at, have your attorneys look at going forward. Did the parents actually take over possession of the property then?
Oh no, they haven't taken over possession of the property. They just
saying that they could.
Yeah.
Well, you might want to try getting a new lien or something that defines their rights and responsibilities better, so that you don't get stuck in that kind of situation. I mean, we've had grantees going back and rewriting liens. It's not the most fun thing you ever did, but people are not impossible to deal with on this for the most part. So they understand what you're trying to do. They understand that they're getting a benefit. Hopefully they'll be cooperative.
Okay.
You might want to put in for some technical assistance through our resource exchange, just to maybe somebody could talk you through some alternatives as far as substitute liens or other kind of techniques. It wouldn't cost you anything.
All right. Thank you.
Okay.
Thank you. Hope that gives you a way forward there. And Marie asks, in regard to income, can child support documented for 2 years be considered for debt repayment if it's the only source of income?
It's 3 years.
It would need to be for 3 years?
So 2 years and 3 years of continuous income. Okay, so for the third year, you'd have to have some other additional source of income. Is that what you're?
Hi, it's Lisa Ellis speaking. In regards to child support, The 2 years receipt of the child support is acceptable for documenting it and utilizing that child support as being income. However, the child support must be documented that it will continue for a minimum period of 3 years from the date of the note.
So we're saying you can use it 2 years going back, but you've got to be able to demonstrate that it'll be there for the next 3 years.
For the entire 3 years.
Okay. Thanks for that question, Marie. And now let's go on to Patricia. Back to Patricia. Hi, Patricia. Are you there?
Hi, I'm sorry.
All right.
I wrote it so long ago I didn't know I was the right one here. I had asked. Oh, okay. When we get to the 50% for the CDBG, 50% of the down payment. Okay. What it says is that you can pay 50% of the required down payment. We've always thought that because we were, and we're not paying it right now anyway, but because we were a governmental entity, the governmental entity can provide 100% of the funds needed. Therefore, the down payment required in that case was nothing. So how does the cap apply and it could happen on a conventional loan if they allow a governmental entity to cover all of the difference. What is the required down payment? It could be on a conventional loan. It could be a number of different things. If you're trying to go back to another down payment that's established for a non-governmental entity, that I'm kind of mixed up.
Yeah, so pretty much all lenders that I know about require some sort of down payment. I mean, maybe there's a few that don't.
Well, under the FHA, if you're a governmental entity, there is no required down payment.
I think
and conventionally, I think that's the same thing. If it's like a housing program or something, and it's paying more than 20%, then there's no required down payment.
Required down payment. Well, let me clarify. So, according to FHA's guidelines, you are correct that the minimum investment of 3.5% can be paid for by a government entity. Now, if the NSP funds can only be used to cover 1.5% of that 3.5, then the other
it doesn't exactly say that. It says that we can only pay 50% of the required down payment. So if FHA is not requiring a down payment, it wouldn't be 1.75. It would be nothing. I mean, there would be no cap.
Okay, so if NSP funds can only be used, NSP funds can only be used for half of the 3.5%, do you have another source of funding as a government entity to cover the remaining half?
I don't think you're understanding exactly. I'm trying to go back and say, what is the definition of required down payment for FHA? If I'm a governmental entity and I'm covering whatever I can cover, would that not be, I can cover the 3.5, correct?
Yeah, you can cover
if it weren't NSP funds and I'm a governmental entity, the required down payment is nothing. So how do you go back to the 3.5 and say that it's only half of that if this situation is different and I'm a governmental entity?
Well, no. Okay, let's go back. Somebody needs to put in 3.5%. So you, as a government entity, are putting in 3.5% for the borrower, correct?
Correct.
Okay. So NSP
can only pay half of that.
Allows you to only pay half of that 3.5%. So there is a down payment requirement. The question is who's paying it. And if you, the government entity, are paying it, NSP is limiting your use of their funds to make that 3.5% investment for the borrower.
So, Arlene, are you saying that, in fact, there is a down payment requirement? It's just that the government entity could pay all of it. So
right.
So Patricia, there is a down payment requirement. It's not nothing. It's 3.5%. It's just that you can cover that any way you want to, except that only half of it can be NSP. So you can
okay. So how would you do it if somebody bought a house that was maybe a little bit too much for them, and they came up with, okay, your down payment in this particular transaction is going to be 10% because of such and such. Then NSP could only pay. This is like conventional, not FHA. Then in that case, you could pay half of it.
Yes.
So anything that's called down payment is subject to that?
Yes. Down payment, not second, not closing costs, not mortgage insurance premium. You can pay 100% of those things. You just can only pay half the down payment. And I think what Congress was going for way back in the 90s there was, some idea that people would have some cash in the transaction. And personally, I still think that's a good idea. So.
Okay, can I ask one other question of Arlene? And I just wanted to verify this. I was under the impression that she was saying that the HERA law does not apply to governmental entities, or did I hear something different?
That is correct. The 2008 HERA law, it's the source of the down payment to fulfill that 3.5% investment minimum. If that source if the government entity is the
seller
entity that's providing that down payment, that is an acceptable source.
Okay, so even if the seller is the seller in our case with NSP can pay half of the down payment.
Yes, you are a government entity. You are not a nonprofit who is not an instrumentality of government. Is that correct? You are a government entity.
Correct. Yes.
Then you are fine.
Okay. Okay, and I also looked up the definition of a non-recourse loan because I had asked that question earlier. And I'm seeing that a non-recourse loan is actually it's a loan that the borrowers don't have to pay back, but they could still foreclose. So is that what you're talking about? I thought the whole theory was not to be upside down so that they couldn't foreclose. I'm not sure.
Right. So I am not defining it that way. I am defining it as, essentially a non-performing note or something. I don't know. I mean, a non-recourse loan is one at which you are not required to repay it.
Right, but see what their definition is: if the partnership fails or the person fails to repay a non-recourse loan, the lender has no recourse against any person except to foreclose on the assets used to secure the loan.
Well,
so I don't think.
Then you're going to be in like a third position. So in order to enforce that, you're going to have to pay off the first and the second mortgage. What I'm suggesting, really, instead of that, is make it a grant.
It's a grant.
100%, maximum 100% loan to value. So let's just forget about non-recourse loans.
Okay.
Let's just focus on 100% or less of loan to value.
Okay. All right. That answers my questions. Thank you.
Thank you, Patricia. And let's see who's up next. Let's go to Marie's question. She says the NSP second lien then does not have to be filed or recorded?
No. Let's see. Is this a written question?
Is this a written question?
It is. Yeah.
Maybe you could read it for us.
That's the whole thing. NSP second lien does not have to be filed and recorded?
No.
He was trying to understand.
So, all right. So, again, most typically, the second mortgage lien that NSP files is below 100% of market value. So you have, let's say, a 95% first mortgage and a 5% second mortgage. Anything up to 100% of value should be recorded and is, in fact, your enforcement tool for the affordability period, any kind of restrictions on the resale of the property or whatnot. If you go over 100%, people were saying that they wanted to have some instrument for that. I've decided that that was a bad suggestion, and you should just forget about anything over 100%. And so anything over 100% is cannot be recaptured, cannot be returned from that property. Therefore, filing a lien against it wouldn't do you any good anyway. But anything below 100% of loan to value really needs to be recorded.
You know, just as common practice in the industry, it's always best to record all liens that encumber the property, just so if there's ever a refinance situation, that new lender is fully aware of what is, what kind of liens are on that property.
Yeah, and it's your kind of tool. I mean, this puts the title company in your, on your staff to some extent, because 7 years from now, when nobody remembers who made the loan to Mrs. Gonzalez, and she wants to sell her house, there's some rules about what happens then, and so that's what your lien should describe. In some cases, the grantees will even have a separate agreement with the buyer, with the borrower, that details, that your loan is forgiven at 10% a year for 10 years, or your loan can only be forgiven after the 10-year period is up, or whatever terms you decide to have. And then when people sell their houses, you're in a position then to get some money back so that you can use those for other affordable housing in your community.
Let's go to Lorraine. Hi, Lorraine. I'm unmuting you.
Hello. Hi. We had the same question on a non-recourse loan. How would you capture the affordability period?
Well, so, when I foolishly brought up the term non-recourse loan, I was talking about something above 100% of value. So you can't recapture anything above a value that there's no value there to recapture. But so there is no affordability period. The affordability period applies in the case of either a development subsidy, or the case it costs you $130,000 to fix up a house, but the market value is only $100,000. That $30,000 is a development subsidy, and it automatically in home defaults to a resale unless you put some direct subsidy in there. Now, the direct subsidy is really what we're talking about with putting liens on the property, because then you have provided something to somebody that basically discounts the price from fair market value to whatever you decide to sell it to them for. And that's the part you want to put a lien on. That's the part you have to put a lien on, in fact, because there's no other way to protect your interest there. So that's where it comes in. But anything above that is gone.
And I guess right now what we heard, you had mentioned, so what would be captured in that second lien would be just the down payment, and then the closing cost assistance should be a grant. So you should have.
Well, I mean, I think most grantees don't make grants per se. They make forgivable loans, or they make loans that. So, I mean, it's treated as a grant. I mean, it works like a grant, but they have some, ability to recapture some of that if they sell the house, because you don't want them to go out 2 weeks later and sell the house for $20,000 more than they paid for it, because that creates a windfall for them. So,
because at this point, I mean, that second lien, the down payment assistance and the closing costs, homebuyer assistance, NSP homebuyer assistance, is being included in the CLTV, and so the CLTV is higher than 100%, and so.
Well,
are you saying that
those are a grant? If it's over 100%, it should be a grant. Yes.
If it's over 100%, it should be noted maybe on that second lien that
it doesn't really get you anywhere.
Couldn't be taken into account, maybe.
The only place you take it into account, I guess, would be the affordability requirement.
Okay, I see that. I could see that.
It still depends on. Yeah, I mean, if it's a grant to them, it counts towards it's a direct subsidy.
So anything over.
How do you enforce it?
How would you enforce it? You
wouldn't.
Anything over 100% is a grant. Right. Is what you're saying.
Right.
Okay.
Basically, the bottom line is that anything that's over 100% cannot be secured against the home, cannot be secured against the collateral.
Okay.
The home's only worth 100% of what it's worth. So anything, I mean, you can do whatever you want, but there's still no value that's over the market value. But you know, so I mean,
interesting.
No, it's not. I mean, so typically, I mean, so maybe your closing costs are on top of whatever else you made a soft second for. You know, so you're not going to recapture those, but you will still. I mean, most people will still make a loan or a loan for closing costs, a small loan on the principal amount in order to get themselves into the recapture mechanism for the long-term affordability, just because it's so much easier to work with. So that's really the number you're going off of. The number is, between 100% of market value and what they actually pay for it is the direct subsidy, and that's what drives your affordability period.
Alrighty then. Thank you.
Thanks, Lorraine. And let's see, we're getting close to the end of our scheduled time. We've got a number of questions left. Are panelists able to stay a few more minutes to answer outstanding questions?
Going over 100%, Ken? Is that what you're telling me?
That's it. We're going over 100%. If that works for you.
I'm not sure I can secure it, but okay.
And let me just remind folks that this webinar is being recorded and will be archived in the NSP Resource Exchange. It'll be there within usually a day or two. And also we've got some upcoming webinars in the NSP realm that may be of interest to you. Hope to see you at some of those. And when you do leave, you'll be automatically taken to a survey form. We'd appreciate you taking just a couple minutes to answer those questions, give us some feedback, and written comments are especially helpful there. So we hope you take a moment to do that. And let's go now. So Suzanne's question goes back again to the down payment. Can the seller, a nonprofit seller of a property, also provide half of the minimum down payment?
No, that would be a prohibited source under HERA.
And let's see, we've got.
So this is the case where the way to work that is to get the government entity to make the down payment loan or grant rather than. But it's a little cumbersome because you have to have the nonprofits having title and so forth. But I mean, it's not the end of the world.
And next up, let's see. So going back quite a ways, Evelyn's question long ago, where she had asked. Where did that go? She had asked, can a principal write-down equal to the rehab amount be used in combination with a 203B or 203K? And she provided some clarification to say that the purpose would be to offset the financing of rehab to reduce qualifying ratios.
Who's paying down the principal?
Grantee, that's probably.
Okay. So the grantee is paying down the principal on the what?
On the amount of the rehab cost, the hard cost.
If they're paying all of the principal, all of the rehab costs, then it would be, we could just do a 203K loan. I mean, a 203B loan.
No, 203K. They're paying for all of the rehab or just a portion? Because it says a write down, but it doesn't specify if it's all
equal to the rehab dollars. So let's assume that's all of the rehab costs. So
if it's all of the rehab costs, then you could use the 203B. If you wouldn't be able to use the 203K because the 203K obviously is to cover rehab.
And in fact, this is what happens a lot. I mean, the grantee, it might not be exactly the rehab amount, but it's a large chunk of money, and they're basically discounting it, and then they're coming in and putting a mortgage on the remaining value, and that's perfectly fine under 203B.
Yeah, not 203K.
It gets just kind of confusing with 203K. We may need some guidance on that or something, but we've been struggling with it. How to make it work. I think one of the big problems there is that your 203K is financing everything. It's financing all the rehab. So, except in the case that Matt used, where maybe you do like the basic rehab to make the house habitable, and then they take out a 203K loan and come in and do the cosmetic improvements or things like that. That's still two rehab processes. I'm not sure that's all that exciting either.
That would be looked at very, very closely by the lender. If that would be at all eligible for a 203K, depending on how much rehab is left to do.
So I'm going to go now to Dave, and then after Dave to Jesus, and then Jenny. So let's first go to Dave. Hi, Dave.
I'm sorry, before we move on, can I just revisit Evelyn's question again? I do want to make clarification that normally the interest rate on a 203B loan is less than the interest rate on a 203K loan. So if you were to write down the principal equal to the rehab dollars and get a 203B loan, you would be in a better position, or the borrower would be in a better position, because obviously the interest rate would be less than if they were ever to work on a 203K, because it's just higher. Yeah. It's just possibly low.
And I think that the other thing that we were assuming is that the grantee is doing the rehab. If you are trying to get money to the borrower, close on the loan and then do the rehab, difficult. You can't really do that with a 203B, and it's overly complex with a 203K. I don't know.
Okay, let's now go to Dave's question, and it's been there for a little while. Dave, are you there?
Yes.
Very good. Go ahead. What's your question?
As a government entity, we can acquire and rehab the property and also resell it and provide the home ownership assistance, down payment and closing cost assistance, correct? We can do both of those activities.
If you are a government entity, but here's where I caution you. If you are hiring or contracting a nonprofit to do either the down payment assistance on your behalf, that would not be allowed unless that nonprofit was an instrumentality of government and proven to be so. So
okay.
Just be cautious of that.
Okay, thank you.
Yeah.
Very good. Let's go now to Jesus. Hi, Jesus.
Hi, good afternoon. Jesus Morales with the City of Corona in California. Can you hear me?
Yep, we can. Go ahead.
And the question I had to do with if we're doing a manufactured home, I found out Fannie Mae, Freddie Mac do not insure buy loans on manufactured homes, even if they're on a permanent foundation, if they have, quote, resale affordability restrictions. And unfortunately, we used the money to do a manufactured home and found out we couldn't get a loan for the buyer on it. So I guess my question is there any reconsideration by Fannie Mae that they need to revise this? Because if other parts of the country are doing manufactured loans, they're not going to be able to get a loan for the home buyer if they have any kind of affordability resale restrictions as part of the agreement for the home buyer.
Well, we can't really speak for Fannie Mae or for Freddie Mac, but on the FHA side, anything, resale restrictions that survive foreclosure would not be eligible for FHA financing. So it depends on how you have these restrictions in place.
So there would be a restriction automatically because it's manufactured home.
I'm sorry, could you repeat?
I don't think that's actually. I mean, this requirement applies to any loan.
Mm-hmm.
So
yeah.
So it's not just manufactured homes. But here's the thing, Jesus. And we had a couple of written-in questions too. So the reason, the time that you would have a problem with that is if you have a resale provision in your program, and the home program rules require that you reimburse the program for the entire amount of that. So you would never want to have a resale restriction per se. What you would want to have is a recapture provision. And a recapture provision under the home rules allows you can be wiped out by a foreclosure basically in that situation. So the way to deal with that requirement is to set up your affordability period and your continued affordability around the recapture provisions and hope that you don't lose the mortgage. But if you do, you won't be having to dip into your pocket to reimburse the fund the way that you would if you did it through the resale provision.
Right. I mean, because we actually have recapture, and I kept on trying to tell them that this wasn't a resale restriction, and they kept on referring me to this underwriter's guideline in the Fannie Mae book that says Fannie Mae will purchase mortgages subject to resale restrictions secured by one-unit properties or two-unit properties. The property must be the borrower's principal residence. Mortgages secured by manufactured homes, co-op projects, 3 or 4-unit properties are not eligible. And again, they were saying because we had a resale restriction, and no matter how many times I pointed out in the documents that it was an affordability covenant with recapture, not resale, it's like people were blind to it and they said, no, you've got resale provisions, so we can't do that loan. Consequently, not even FHA lenders would want to do that loan for the same reason.
Well, again, I mean, I can't really speak to Fannie Mae, but for FHA, you know, they need to follow our underwriting guidelines, and they, above and beyond that, they have a choice to decide what loans they're going to do and what loans they're not going to do.
But Arlene, this is Matt. I think his question has to do specifically with manufactured homes, and what I'm hearing you say, correct me if I'm wrong, FHA doesn't have any specific prohibition against manufactured homes and any kind of secondary financing covenants. In other words, if it would be permitted otherwise by FHA, the secondary financing, just because it's manufactured home would not be a problem.
Yeah, the type of, I mean, if it's a manufactured home, especially one that's secure, that's on a foundation, right? That's what was stated.
It's a manufactured home that would otherwise meet the definition of a fee simple transaction and under FHA guidelines.
This is an example of Matt's point of, you know, there's more than one lender out there too, and some of them actually have 3-digit IQs, you know.
Matt, this is Jesus Morales. If you know a lender, please contact me in the city of Corona, because we called a multitude of lenders and they all said no, even when I asked about FHA loans.
I have some ideas for you, and I'll get back to you later, Jesus.
Thank you.
Thank you, Jesus. And Jenny's up next. Hi, Jenny.
Hey, how are you?
We're doing well.
I have a question. So one of the cities that we manage is doing a resale provision. It's developer subsidy, and they have a 15-year deed restriction on the property. That the dollar amount on it is inclusive of the total subsidy, so a full $150,000 when the market value of the home is between $72 and $99. We obviously need to record that lien and restrictive covenant or the resale agreement. What is the best way to record that without having the problem we've had is immediately a lender comes back and says this is over 100% CLTV. However, there is no soft second or second lien that's actually filed. It's just the resale agreement is recorded in the office of the recorder.
Yeah, I think you want to go back and revisit your structure on this a little bit. But so the amount over the 90 that it's worth, let's say, $60,000 there is the development subsidy.
Right.
That's gone. Now, as you mentioned, I mean, you're defaulting to, as the home program does, defaulting to resale restrictions, which require you to pay back the full amount, not the borrower.
Right.
But what you really want to do in this scenario is to, because I mean this is unfortunate because in effect the family is paying 100% of market value for a house and getting no direct benefit and has a 15-year repayment restriction. So what you want to do is come into those scenarios with writing off the $60,000 development subsidy, and then make a soft second loan for $5,000 of principal reduction, and then that gets you into the recapture model, and it's legitimate to do it that way. And we've had Ginny Sardone from the home program on a webinar last summer, and specifically after this. So you're really creating. I mean, the situation is creating an impossible sort of set of outcomes for you.
Okay. Now with this particular city, they are they received their funding through the state housing authority and are being required to use resale and use their resale agreement, and they are requiring us to put the total amount of NSP funds in the property on that resale agreement. Like I said, we're not technically filing it a soft second or a second lien, but we are putting that resale agreement as a miscellaneous document on file with the recorder's office. Right. And the problem that we've had is when they run a title search, they pull it up and they say, well, but there's, $150,000 lien on the property. It's not a lien. We're never going to ask the home buyer to pay it back. How do we get that across to a lender?
I'd be more worried about how you get it across to the state. I mean, I think that, you really ought to see if you can sit down with the state and say, there's another way here. But
so I'm not crazy when I think that the state has backed us into a very difficult corner with a lender.
Well, I mean, I think, in fairness, there's a lot of complicated cross-cutting rules here, and everybody's, a little confused. So, but certainly you're allowed to do that. Whether you could talk the state into doing that, I don't know. But in the scenario that you're talking about, the borrower is not liable for the $150,000.
Correct.
It's not a lien, so that it's not. You're not recording that against the borrower. You are basically pledging the resources of the grantee or the sub-grantee to repay that as HUD requires.
Right.
In the resale program. So you're not violating the 100% rule, but you are getting into a financing model here that is, really very could be very punitive if people default.
Okay.
So I mean that's just the way it's written, and Jenny was telling me that that was the only provision at the beginning of the home program, and they actually went back and got some additional flexibility from Congress to create the recapture. So it's just been around for a while. Some folks are just kind of bought into it. I mean, but we would be happy to talk to people. I mean, if you want to, try to get get your field office if you can, or somebody here in the NSP office to talk to the state and say, look, there's another way to do it. Now,
Okay.
We can't force states to do it another way because they have something called, they receive maximum feasible deference from us. So if they want to keep it, they can keep it. I guess your choice is not to take the money, which isn't a great choice either. So.
Right. Now, is all of your contact information is available at the end of this or somewhere here?
Yeah. Yeah.
I'll go back to that slide.
Thank you.
Yep. Thanks, Jenny. Getting closer to the end here. I'll try to wrap this up quickly. Patricia asks, she states that we can't make any money on the transaction, so at times the purchase price is less than appraised value. If we can't cover more than 100% of the lesser purchase price or appraisal, then the buyer may get an advantage. Are there any exceptions?
Well, the buyer may get an advantage if you create a situation where the value is higher than what you're selling it to them for, and that's true in a lot of cases here. And the way that you prevent that advantage, the way that you prevent a windfall, is to put a lien on the property that requires them to repay a certain amount. So it's only forgiven over a period of time, or it's only forgiven at the end of the note, or whatever it is. That's why you do this. And so, it's a good point, but I mean that's what liens are all about, and they work for you in the sense that you don't create an advantage for somebody, or you are giving an advantage to somebody, but you're requiring them to earn that advantage by residing in the home for a number of years, and that seems like a fair deal to most people.
The other point I just want to make quickly in that is the goal is not necessarily to make money here, right? The whole intent of the program was to address a void in the housing market, right? So you have these NSP funds that are coming in, purchasing some of the worst property that's on the market in many cases, and if that requires that you add a subsidy big enough to make it affordable for the home buyer, then that's sort of what's expected.
We do.
And let's go back again to Laura and I think Leslie's question about the combined loan to value. Can you provide a date of written guidance about that, not exceeding 100%?
Well, it's implicit in a number of things we've said, but David's volunteering to make it explicit.
Yeah, I'm gonna. John and I will write something up on this. But if you look at Section J, I believe, of the NSP Unified Notice on sale of homes, it speaks to the maximum amount that a home can be sold for.
Right. So, and people have mentioned this during the day, but the lower market current market value, or total development cost. So this is 100% of market value is 100%. So that's just where we go. I mean, that's no lender is going to do that either. Basically, there's a few little sort of side deals here, I guess, but we want to get people into houses that they can stay in and maintain and keep up over the years, and so we don't want to saddle them with anything greater than is really fair. But we've been sort of writing about this off and on for a couple of years now, and obviously there's still a lot of questions, and we'll try to clarify that with some new guidance here in the next couple of months.
Marie asked, is it required for a home buyer from 80 to 120% of AMI to obtain NSP homebuyer assistance if their DTI is within requirements and they have sufficient funds to cover all applicable homebuyer closing costs?
Well, no. I mean, you don't have to provide any direct subsidy. The problem is if you don't provide any direct subsidy, then they have to abide by the resale provisions, and most people aren't going to be willing to do that if they're not really getting some kind of benefit out of the program. So, I mean, if you're putting somebody into a house that costs $150,000 to build, and just because the market is screwed up only is worth $90,000 right now, but is going to be worth $150,000 in 5 or 10 years, then they might say, well, that's worth it. But if you're in a slow-moving market and to expect somebody to get into a house that and pay all their own money and not get any assistance, just not. I don't think it's just realistic from a sales standpoint.
And let's go to Shelley. Hi, Shelley. Are you there? Hello, Shelley. I guess not. Wait a minute. I heard something. You there, Shelley?
Yeah, can you hear me?
Yes, now we can.
Okay, perfect. Sorry about that. I was trying to use my headset. I guess this is back on the CLTV, and I guess I just have to, I heard the comments from Patricia, and I just wanted to, I understand the guideline on the sale of the home, but I guess my question is, it seems like NSP is trying to put an overlaying restriction on a guideline that FHA does allow when we're talking about the CLTV over, 100%. If it goes to, like, say, 103 or 105%. So,
sure. You don't have to use our money, but when you use it, that's the rule.
Okay.
Sorry.
All right. And then second thing that I wanted to bring up, when you're talking about the homeownership assistance, we had originally was told if it was principal and interest write down or considered a gap, that actually could go up to 100%. That it was not actually, it could be, I guess, separate or different than the down payment.
Well, I think the down payment is always part of market value, isn't it?
No, I'm sorry, it's a different subject. I'm talking about the homeownership assistance. So we called our homeownership assistance as that you can use it towards closing costs or principal and interest write-down. So basically the gap that was needed. Right. And in that situation, if it was called homeownership assistance, there was not a requirement for a down payment. Is that wrong?
Well, I mean, it's not our requirement, Shelley. So I mean, you can use homeownership assistance. You learned that lesson, so that's good. So homeownership assistance is principal write down, more interest write down, closing costs, any of that stuff. It's also down payment. If you have a down payment requirement, it's limited to half of that. We don't have any opinion about whether there is a down payment required.
Okay. And even when we can, I guess, provide that to 100%, it still is going to cut me off at the 50%.
Right. Yeah. So you could go.
Whatever you define as your down payment.
Right. 50% of that. Right. So I mean, so that's why you want to define the down payment as cash at closing, equity, borrower's equity. Everything else is unrestricted in terms of the level. I mean, it's from a percentage standpoint. Anything that's needed, you could do, but in this case, if it's an FHA loan, you could go up to 98.25%. You'd still have some kind of a down payment requirement, even if you covered all the other stuff. Now, if you have other sources of funds and choose to make that the other half of that down payment, you may. But if you go above that, then if closing costs aren't included in that, and you pay closing costs, then that's just on top of that. Has to be a grant, basically.
Okay, or you could have the seller pay the closing costs, and then it just comes out of, it's just considered a development subsidy at that point. Is that correct?
Well, I think closing costs are still closing costs, not development subsidies. But they're still, you know, they could still be above 100% of value. You just can't lien them. You have to give it to them.
And if you give a grant for the closing costs, what mechanism, how would that look?
Well, I mean, it wouldn't be recorded, so I don't know. I mean, you know, I would think that you'd have some sort of a summary of your transaction with the buyer that says, you know, here's the sources and use of the funds, you know, and maybe, I don't know what it looks like on a HUD-1, but, I mean, you'd have, you know, you'd show that this was being paid as a grant by the county or whoever, and it's not going to be part of the financing because you don't have anything to go against.
Okay. All right. Thank you.
Thanks, Shelley. And one final question here. Angelia, I apologize. I bypassed your question up higher, and see you trying to get our attention here, and here it comes. So she asks, even if the approved lenders for our NSP program can do a combined loan-to-value of up to 105% of the sales price, we as the seller/city are not allowed to provide, say, up to 104% of the sales price, even if our second mortgage is based on resale. Is this true?
Yeah, that's what we've been saying, yes. So in that scenario, you'd need to cover that 4% with something that wasn't requiring repayment. And, you know, so the simplest way of doing that would be some sort of a grant. But, you know, again, if you're taking it right down to 100%, then you're into resale. So, I mean, as long as you're at it, you might as well make it 99% instead of 100% and get yourself into a resale scenario. A recapture scenario, yeah. But yes, that's what we're saying. You know, I'm sure that based on this conversation today, people have done it differently. You know, we're not going to go out and penalize you, I don't think, for you know, honest mistakes, but you need to try to get your liens and your financing straight from here on out.
Well, thank you, everybody. Matt Callahan, Arlene Nunes, and John Laswick and David Noguera for all of your answers and presentation today. And for those of you participants who are still with us, thanks for your attendance today. We look forward to serving you again in another NSP webinar. And again, when you leave, if you take a moment to complete the very short survey that you'll be taken to, we'd appreciate that. And we look forward to seeing you all again soon. Take care, everyone. Thank you.
Thank you.